Welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, profit sharing plans and index universal life policies, part one in our series on tax advantage income investing with indices with nationally recognized retirement expert and certified financial planner, Chris Jacob. Welcome to the first segment, Chris.
Thanks, Steve.
Chris, we've had you on before. We're talking about indexing with universal life. Now, you can do foreign and domestic indexing. You don't have to stay with the S&P 500 exclusively, right?
There are 6 to 12 different indices that you can allocate to.
Foreign.
Yes.
You could do a combination of
Hang Seng, Euro stocks, you name it.
So you don't have to necessarily say. Now, I noticed last year they said that 72% of the time, though, anybody that's doing indexing on annuity platforms and or life insurance platforms are using the S&P 500.
Yep. You're not relegated to it, but it is the most common.
Okay, when I'm looking at this, I want you to kind of walk us through the basic premise of life insurance in a qualified plan. You're a CFP, I've always heard. I thought that was anathema, but you use it, and you're one of the toughest guys. You're a scrutiny guy. You walk over everything to see the economic value of doing something. Tell me why we're in a qualified plan with a life insurance contract.
I will, and there's a 4-letter word that I use that I will tell people. It's a 4-letter word that is not a dirty word, and it's the only word that I can use in order to show the efficacy of this, and it's called math. Okay, and that's what we're going to talk about when you look at these qualified plans where people have put a bunch of money in there. How can we, if you will, extricate some of that money and do it under a tax-favored basis? And believe it or not, life insurance is one of the ways in which you can do that. So we have, a lot of people have a lot of money in what I'll call government-controlled plans, qualified plans. And, you know, we talked about this before, Steve. What are the various taxable vehicles? Well, I got taxed as you go, capital gains tax, stocks, bonds, mutual funds. I got tax deferred, or if you'll remember from another meeting, we talked about tax postponed. Eventually, you're going to pay the tax. And then you got the tax-free, Roth and life insurance. So really, the government has a lien on these assets in your tax postponed plans. At some point, you're going to, it's a mortgage, basically. You just don't know the terms, right? Okay. So if we look at this, somebody's got $1 million in their plan. If they really don't have $1 million, they got $600,000 after, okay? And after income tax. If there's a state tax, which that's less likely to be, fewer and fewer people are subject to that, it really can be kind of an IRA for the IRS. So what can we do about it? Well, these are the typical, if you ask your CPA, you ask your advisor, how can I get money out of my qualified plan? IRA, 401k, here's what they're going to say. Well, just spend it as you need it. You'll pay tax on it. Hey, I don't need it. I'm just going to wait until the government forces me to take required minimum distributions. That'll be taxable. Convert the whole thing to a Roth. You can make the case for that, but does anybody really want to write that check? No. If you don't need it for retirement, here's one way to at least exit the taxation on the back end when you pass away. Just take what you have to take for RMDs and then give it away. Might be a big spoiler alert for your kids. Or, as we stand here today, you can still do what's called the inherited or the stretch, where the kids can stretch it out and pay tax over their lifetime. All of these entail tax. Can you tell me, can you think of anything else you can do with this money?
No, and I don't want to pay the tax, but I don't know if there's any other way.
Well, let's talk about the potential of freeing yourself from the bank of the IRS. Because currently, these plans, these qualified plans, have rules and regulations. You got to qualify to put money into them. You got to qualify to take money out. And these IRS tax lien rates, think about this, as your investments grow, you just got a bigger tax lien on that money, right? So you kind of get penalized for successful investing. For lack of a better term, we'll just call this the POP plan, the pension optimization plan. And one of the ways in which you can do this, most people aren't aware of this, is you can own life insurance in a qualified plan. You can't own it in an IRA, only in a profit sharing plan. And if we do that, we're still going to have a lien, if you will, as you'll see. You get to pick, but it's going to be commercial, smaller, fixed, and you don't get penalized for successful investing. So all we're trying to do is take that money that's on the left side of the wall that's currently subject to, in some cases, pretty confiscatory taxation, and get it over to the other side of the wall. And one of the best ways to do that, if you've been watching our series on life insurance, is an indexed universal life policy, however, owned inside of a profit sharing plan funded with pre-tax dollars. See, why does this work? Because if you do the math, and we do, and we will prove it, that over the long run, and we said the long run, the taxes and management fees associated with the typical qualified plan are much higher than the insurance charges associated with a life insurance policy. Okay? That's basically what it comes down to. So let's look at this. Somebody's got $1 million in qualified plan assets. It's in a profit sharing plan, let's say. The profit sharing plan can own life insurance. It does. And in this case, we'll just say that we're going to fund it over the course of 3 years. And we'll use $333,000 a year for 3 years. If you've been watching our other installments, that $3.5 million gives me what's called a non-modified endowment contract. It will be a tax-favored policy when I distribute it. There's some special rules and regulations you have to pay attention to. For instance, there's some pretty specific regulations when it comes to how much of the money can be used to buy life insurance. Well, usually 50% for whole life, 25% of contributions for universal life, but something called the season money provision allows us to use 100% of the money, depending upon how long it's been in there for the purchase of life insurance. Usually, Steve, this is an actual case for a dentist of mine. He's my dentist. Their volume submitted 401k profit sharing plan document looks like this, and 99% of them out there look like this. That life insurance may not be purchased. Well, in order to make what we're going to talk about work, we just have a new adoption agreement with now these boxes checked. Yes, it may be purchased at the option of the participant with no limitations. That's all it takes. Now, Steve, why would these plans not have life insurance checked as an option? Who's making money? Does the investment manager make any money off of the money that's in the life insurance policy? No. Follow the money. So how about, hey, I got an IRA. It's not in a profit sharing plan, but geez, I would really like to do this. Well, there's one of the gurus in our business, Ed Slott, CPA, when it comes to these retirement plans, has a book, and in the book, he has a chapter on life insurance where he refers to something as the rollback strategy. And in it, he talks about if you have an IRA, you can't buy life insurance in an IRA, but you can roll it back into a profit sharing plan, either an existing one or a newly created one. That money then counts as seasoned money, and I can use 100% of it for the purchase of life insurance.
Does that seasoned money, when does the clock start? When it's been in a qualified by 2 years?
No, just by virtue of the fact that it was in an IRA and it is now coming into the plan, which it can, okay, that automatically kind of grandfathered it, if you will, as seasoned money.
Even if the IRA was 2 years old or whatever?
Doesn't matter.
Doesn't matter, okay.
Doesn't matter.
So, coming from another ERISA jurisdiction, IRA, rolling into your profit sharing plan, that's seasoned money.
Correct.
Maybe I had a profit sharing plan and I already had money in the plan. How long do I have to have it in there to do that?
Well, you have to have had it in there for 2 years to use 100% of it, or you were a plan participant in the plan for 5 years. Either one of those, I can use 100%.
If I've been a plan participant, but I've been in mutual funds, I could use all that, you say?
You can use 100% of it.
All right, okay. So we just have to obey a few laws and understand the definition of seasoned money.
That is correct.
All right, okay.
Yep. Okay. So let's look schematically we got a profit sharing plan that owns life insurance. Our ultimate goal, however, is to get that life insurance out of the profit sharing plan. Now, there's two ways I can do this. One, I can purchase the policy, which we covered this extensively in another series of videos that we did. I can purchase it for its fair market value, but there is one other way I can get the policy out. I can just transfer it out. I transfer the policy. So while it's in there, the owner of the policy is the profit sharing plan. I now just change ownership from the profit sharing plan to me. And when I do that, that will count as a taxable distribution based upon the fair market value, which there's government rules and regulations which will show you this is what that value is. Now, as an aside, there are only a finite number of insurance companies that will even allow their policies to be owned by qualified plans. And furthermore, there's only a finite number of those that have the features that we're looking for that we've talked about in recent videos, which is fixed rate participating loans. So just a small number of companies that this will even work for. But in this example, which we're going to get into some numbers in the next segment, if I put $1 million in and I transfer it out, I'm going to be taxed on $800,000 of fair market value. So in a way, I kind of got a little bit of a discount there that I didn't have to pay tax on $200,000 of it, but I'm still going to have to pay tax on $800,000 of that. So it's now outside. So let's just say in year 4, my policy got transferred. I funded it for 3 years. In year 4, I transfer it, and going into next year, I'm going to have a tax liability on $800,000. Where can I go to get the money to pay the tax on that policy transfer tax? I got the shiny new life insurance policy that was in the profit sharing plan that now resides outside of the profit sharing plan. And I can utilize a loan, not from, but against the value of the policy. So it's still kind of a potential profit center for me. So if I've got $800,000 and I'm in a 50% bracket, I need to stroke a check for $400,000. Could I take it and take it out of other funds? Certainly. Could I go down to the bank and use my policy as collateral and take an interest-only loan from the bank? Yes. I contend the better bank is the insurance company. They will lend you the money, and they will lend you the money based upon the collateral capacity that you have in the policy, which is $800,000. You easily qualify for $400,000. So I now take that $400,000. Does the government care where we get the money to pay the tax? They do not. So that $400,000 now gets borrowed against the value of the policy, paid to the federal government. I now have a life insurance policy outside of my qualified plan that's tax favored, that as you're going to see in our next video series, that I can subsequently take money out as retirement income.
Don't forget to watch our next segment, which is a case study on Index Universal Life in a profit sharing plan. Part 2 in our series on tax-advantaged income investing with indices. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.